Let's get across the market open now. Kerry Craig joining us from JP Morgan. Kerry, welcome. Good to have you back on AusBiz. Now, of course, we've just had a press conference from Donald Trump outlining his plans for tariffs for the car industry.
Yeah, good morning, Andrew. I mean, it wasn't too much of a surprise. Obviously, things like pharmaceuticals, the auto industry, and now lumber are being sort of identified as sectors where you'll see further tariffs coming in. The timing might be a little bit of surprise given we are going to have further announcements come through on April 2nd. And there had been some downplaying in the fact that we would have sector-specific tariffs in the last few days. However, it does fit with the narrative around trying to build up the US industrial base, thinking about creating jobs. But in the meantime, I think it's just a case of thinking about the uncertainty this is going to create for markets as we dissect the details of the announcement and figure out where the pain will be most felt, probably by European companies and Asian car makers particularly, and how that might feed through into the rest of the supply chain across Canada and the US. It's also worth noting that these tariffs are in addition to the existing tariffs that Joe Biden put in place, which were 100% on electric vehicles that were imported into the US. So again, putting more pressure, particularly around that part of the car industry.
So, should we figure there's going to be further reciprocal tariffs put in place, in terms of retaliation at least?
Yeah, I think so. In the case of how countries behave, it won't be the same for every economy. But I think places like Europe, you're seeing a different approach in terms of what this actually means. You've already seen them announce certain tariffs on goods coming into Europe from the US. I think you'll see that play through as well in terms of what we hear on the auto industry. By and large, this just adds to some of the growth concerns, particularly around Europe, where things had been looking better, and factoring in some of the price increases we may see play through. While we're still debating, how much of these costs will be borne by producers rather than consumers, on the whole, it does sort of weigh on the idea that the inflation outlook could be a little bit stickier, particularly in the US, than it has been in the past, and also brings into those downside growth risks as you see this disruption play through. And I think for investors, quite clearly, when asked about it today in the press conference, President Trump didn't seem too concerned about the market reaction, again, is focusing on the economy and not being driven by what the market is doing. So again, the idea of that Trump put being sort of moved to the sideline is something else that the investors will need to contend with.
What effect is this likely to have on earnings in particular? I mean, you mentioned the impact, obviously, as far as potential inflation is concerned, but also, I guess, those investment decisions from firms and the uncertainty that remains.
Absolutely. I mean, you just look at the performance of the auto sector in the US going into the close today, quite negative. There's going to be a lot of sort of discussion around the need to, re-engineer capex, whether they're going to have to bring that into production based in the US relative to elsewhere, the cost associated with that and what that delivers to earnings. Whether there will be increased competition from other companies who look to bring onshore manufacturing capabilities to the US and perhaps could do so at more efficient prices. So I think this will weigh on the earnings outlook for particular sectors. And again, I think there's more of a risk around the growth outlook, more importantly, being softer in the US and what that does to overarching earnings. You've already seen earnings expectations so far this year in the US being downgraded. However, you have seen valuations fall as well. So the impact on multiples hasn't been nearly as severe. But overall, and our base case is still one of slowing growth in the US economy, but not recession, and earnings growth that is still running at around about 10% on consensus forecasts. So we are still looking at the US market and for opportunities that are created by this volatility, but with a very more focus on a defensive bias within that.
What of the local impacts here in Australia, Kerry? How much are we likely to feel here? Potentially Australia could escape the worst of these tariffs, but then of course we need to consider perhaps the second order effects, particularly if China is hit.
No, absolutely. I think the direct effects will be relatively limited given we have a free trade agreement with the US. The reciprocal tariffs are virtually zero, so we should largely escape the bulk of anything that comes through there. There'll obviously be certain sector impacts as we're seeing with steel and aluminium, potentially copper, but our copper exports to the US are also very small. I think the second order effects do play more of an important role in terms of, what happens to the outlook for global commodity prices. How much does that impact sort of income into Australia through our mining sector, and then obviously what that means for the broader economic outlook, and again what that could mean for things like the currency, which have been very sensitive to the global growth outlook. I think for the share market here, there's been a very close correlation between what we're seeing in the US and what's played out in Australia, comparatively to what we're seeing in Europe, for example. So it's more likely the local market is going to take the US lead for the near term, and that volatility and sort of downward pressure being felt a little bit more here than, say, we're looking at offshore. But by and large, we are seeing a bit more of a cyclical rebound in the Australian economy and potential for some sectors to start to perform a little bit better if we think about the pickup we're seeing in consumption as well. So it is very much a diverse market environment in both the local Australian market and offshore. So I think there are opportunities there, but by and large, we would say it's probably best to have a bit more of a defensive bias when it comes to the equity market at the moment, and think about those hedges in your portfolio across the fixed income space should there be a bigger growth shock.
So, Kerry, obviously the focus has been on the federal budget, although perhaps the market more interested in what it saw in the latest inflation data and what that means, certainly as far as interest rates are concerned.
Yeah, the budget, a couple of surprises there, and obviously thinking about the cost of living subsidies that are coming through, whether they're going to be extended. They're again showing up in the inflation numbers that we got, given the down one number there for electricity. But even if you look beyond that and some of the trimmed mean numbers or the underlying core inflation, again, relatively soft. And I think even though it's a monthly series and the RBA focuses on the quarterly numbers, it's more likely to see a relatively softer quarterly figure when it is published. That will feed through into the RBA's view that the direction of inflation in Australia is on that downward path and give them more comfort to ease policy again, more likely in May than before that. And again, that they'll have a view that policy here is still relatively restricted. And if the economy is still kind of soft, they can further ease policy on that back of that. So we would, again, expect to see another 2 to 3 rate cuts this year from the RBA, given that inflation path is coming down. And we are seeing a slow recovery in the economy, but not an overheated recovery, which would need them to actually keep rates at an elevated level or even think about hiking them in this environment.